Seller finance flip. I am not a lawyer or accountant. None of this report may be construed as professional advice. Please consult with a licensed professional for your specific situation. Seller finance flip. Many investors have a business model of buy, rehab, rent, refinance, BRR. They buy a distressed property with short-term private financing or hard money, renovating the property, then refinance with long-term cost-effective financing and rent out the property. For many investors, this is a time-tested proven model for wealth creation. On the other hand, the main issue with renting is that the tenant has a renter mentality. They do not respect the landlord's property because it isn't their own property. They often trash the property because they do not respect other people's property. Renters certainly will not invest their own money to improve the property. People never wash a rental car, or why put money into a property when you're only renting it? There is an alternative business model called seller financing where the property is purchased with all cash at a distressed price, renovated, and then sold to an owner-occupant with seller financing. As an investor, you can acquire passive income with mailbox money, instead of rental income. You can also receive chunks of cash with this model. You can be the bank instead of the landlord. When you are acting as the bank, you have no responsibility for repairs or maintenance. If the air conditioner breaks or the roof leaks, the property owner does not call his lender to fix it. Instead, he calls the repair service and then he pays for the repair service. Real owners have an owner's mentality. How can you be a bank when your financial resources are low or non-existent? Use other people's money, OPM, to fund your deal. Find a private lender or a hard money lender to provide the short-term financing to pay cash for the distressed property and for the renovation costs. You want your all-in short-term financing at less than 60% of the after-repair value, ARV, which includes all costs for acquisition, closing, carrying, your supervision fee, and renovation. Note, the ARV is different from the seller finance value, SFV. Find a bank or other private lender who wants long-term cash flow, mailbox money. Self-directed individual retirement accounts, SDIRA, are a great source of long-term financing at reasonable yields of about 12% to 16%. Sell the property to an owner-occupant with seller financing, and then sell the note to the long-term lender. You receive a chunk of cash for selling the note to repay your short-term lender, you receive monthly net cash flow, you sold part of the monthly payments and kept the difference, and you receive a partial balloon payment at maturity. Hypothecate, pledge, the note to your long-term lender for a loan. You receive a chunk of cash from the loan proceeds to redeem your short-term financing, you receive monthly net cash flow from the spread between the payments received from the note payer and the payments you make to your long-term lender, and you receive a balloon payment at maturity. If you can arrange a fully amortizing loan from your long-term lender, then the seller finance note balloon payment is all yours. A long-term private equity financier can redeem the short-term financing in exchange for a strong yield by sharing the created equity for interest income and future balloon payment. By the way, when you are starting out, I strongly recommend retaining a reputable loan servicing company or bank to receive the payments and to disperse payments to the lien holders. A professional servicing company will provide accurate accounting statements and provide the IRS 1098 and 1099 tax reports for mortgage interest income. When you grow much larger, then you can consider moving this accounting function into your business. A loan servicing fee of $35 per month per note will add up when you have income streams from 50+ notes. Many investors take pride in their portfolio of real property, while other investors take pride in their portfolio of cash flow notes secured by real property. Rather than saying, I own this property and that property, you can say, I own the note on this property and the note on that property. This is called mailbox money. The passive income appears in your mailbox every month, or wired directly into your bank account by the loan servicing company. There are certain tax considerations for owning the note, instead of the property. A property owner can defer capital gains taxes when selling one property to buy another property. Also, net rental income is sheltered by depreciation, phantom losses. Note holders do not have those tax benefits. Net interest income is taxable as ordinary income, at the higher marginal tax rate compared to capital gains tax rate. If you created equity in the property and sold that equity with seller financing as an installment sale, then you may have some tax shelter for your capital gains, depending on how long you owned the property before you sold it. Some investors dispose of the property with a lease option agreement that defers the title conveyance until the property qualifies for an IRC 1031 tax-deferred exchange. The option contract provides for seller financing at the time of exercise. Your certified public accountant, CPA, can provide more details on the available tax shelters for interest income and principal repayment. The main benefit, therefore, is in the yield on the investment, which can often be significantly higher than the cash-on-cash return (CCR) for a rental property owner, and no maintenance costs or liability of ownership. Passive income from seller finance notes is mailbox money. The convenience and high yield of mailbox money is worth the trade-off of the tax benefits. For example, a traditional rental property owner may invest a 30% down payment to buy a rental property. A typical rental owner may receive 10% CCR on that investment and is still responsible for repairs and maintenance. Most of the profit from the accumulated net cash flow may be lost upon move-out due to make-ready costs to clean, repair, and replace the damage caused by the tenants above their security deposit. Also, the time to make ready is lost income, i.e., opportunity cost, from the next tenant. Another consideration for the rental owner is that the property price for an owner-occupied single-family residence, SFR, is based on comparable sales. Nice homes in nice areas are usually too high priced to produce a net cash flow from the market rents without a significant equity investment, down payment. The higher the equity investment, the lower the effective yield. Market rents are an important gauge for measuring the potential net cash flow for an income property. The wise investor only invests in areas where the properties can provide a conservative net cash flow with a safe debt coverage ratio, DCR. The best deals on distressed properties are in rental communities where the landlord has had it with problem tenants, maintenance headaches, etc. By the way, good deals can be found in owner-occupant communities, but they are rarer because such homes are usually much higher priced than market rents can afford to pay. Either way, you must be certain that the neighborhood is well established with stable, decent quality residents. Look for motivated sellers that are advertising the property both for rent and for sale, on free websites like Craigslist.org, FSBO.com, FRBO.com, FurzaleBiOwner.com, ForentiBuyOwner.com. You are looking for smaller homes with not much curb appeal, probably pre-foreclosures or foreclosures. Your target buyers are already living in a rental community somewhere, and they will be comfortable owning their home in a rental area. The potential sellers, landlords, are familiar with income valuation, so you can show them the reality of the numbers when you make your offer. They have no emotional attachment, probably an emotional detachment, with the property, and the landlord just wants a fair offer to be rid of it. If your first offer is accepted, then you offered too much. Start your bidding 20% below your calculated MAO. The all-in investment must be below 65% ARV, and preferably below 60% ARV. Your maximum allowable offer, MAO, should be below 50% ARV for a cash offer. Seller finance qualifying. This kind of seller financing is for owner-occupants who have been declined by banks, including lenders who offer government-backed loans, such as VA, FHA, and USDA that have very low or no down payment requirements. The buyers have modest down payment, at least 10% of the purchase price or $10,000 whichever is greater, plus closing costs, and they can afford the market rent, but their income is difficult to document. They are not deadbeats. Most self-employed people have a good steady income that is difficult to document, such as general contractors or consultants, because they have multiple variable sources of income. They are always looking for their next client. By the way, many of these potential buyers think they are stuck with lease with option to buy, and they think they can never exercise their option to buy. Unscrupulous landlords that offer lease option will onerously structure the terms so that the tenant will never be able to exercise the option. The tenants are stuck paying higher than normal market rent for an option that they can never exercise. You can offer these folks a viable solution for owning their home at a fair price on terms that they can afford. Your alternative is much better than the lease option. A careful review of their credit report, their last 12 months of banking statements, and speaking with their references, both personal and business, is required for determining the reliability of the prospective borrower. In general, their gross income must be at least 3 times their housing payment and at least 2.5 times their total debt service. This is called manual underwriting, as opposed to automated underwriting that banks use to filter out borrowers who don't fit their computer spreadsheet criteria. Calculate their average monthly gross by discarding the lowest and highest month in the last 12 months, and then averaging the remaining 10 months. Just add up the months and divide by 10, easy peasy lemon squeezy. Use that average number to qualify their ability to repay, ATR. Do not sell on terms to a walking bankruptcy, always decline insolvent applicants. Be sure to explain clearly in writing the exact reasons why you are declining an applicant, so that if they were to correct all of those reasons, then you would approve them. If you intend to pledge or sell their note, then you must disclose that intent in writing, and advise them that it is a condition for offering credit to them. If you are unable to monetize the note, then the property sale will fail, and you must refund everything they paid into escrow. The lure of guaranteed rent for Section 8 tenants can be a huge problem, because they have not demonstrated financial literacy, insolvent. If you offer home ownership to Section 8 tenants, you must use the joint venture. They must have an ordinary lease agreement, and their responsibility for all repairs and capital improvements must be mentioned only in the LLC operating agreement, or else the government will revoke their Section 8 status and sanction you. Your owner-occupant buyers are entitled to the home loan interest tax deduction, which will increase their net income after taxes, but do not try to justify a higher payment because of tax savings. They may not see an increase in their net monthly income because their income varies each month due to the nature of their business. The net increase may only be apparent on a quarterly, semi-annual, annual, or seasonal basis. Dodd-Frank legislation. Important, the Dodd-Frank legislation requires that a licensed residential mortgage loan originator, RMLO, provides the required paperwork for originating a seller finance note and security instrument for a residential owner-occupant borrower. The legislation also applies to lease option agreements and installment land contracts, ILC, or contract for deed, CFD. Your owner-occupant buyer must be pre-qualified as to their ability to repay, ATR, and the seller financing terms must be within certain guidelines. https://calltheunderwriter.com. Exemptions apply when the buyer is an owner-occupant buyer, consumer, and the seller is selling one property in any 12-month period. The seller is a natural person. The seller did not construct the property. The financing has a fixed rate and does not adjust for the first 5 years. No negative amortization. The seller sells 3 properties in any 12-month period. Corporation, LLC, partnership, trust, estate, etc. The seller did not construct the property. The financing has a fixed rate and does not adjust for the first 5 years. No negative amortization. The borrower has a reasonable ability to repay, ATR certification, the loan. No balloon payment. Don't even think about jacking up the interest rate after 5 years to force the debtor to refinance the loan. In almost every situation as a real estate investor, you cannot comply with the restrictions to qualify for the licensed underwriting exemptions. Therefore, always retain the services of a licensed underwriter to qualify the owner-occupant to buy on your payment terms. Your buyer will pay the underwriting fee, usually about $500. You will also need an experienced attorney to provide oversight and approval of the legal documents to be sure that all parties are protected. The sale must be closed by a reputable title company or a law firm, and title insurance for the buyer and the lender, is required. Do not even think about using CFD or ILC. They have state-specific legal interpretations, including property tax escrow and legally required judicial foreclosure, sometimes called an equitable mortgage, which can take a year to complete while the deadbeat lives in the house with no payments or repairs. If you try to evict the deadbeat as a tenant, then you must explain to the judge why you are intentionally violating landlord-tenant laws by requiring in the contract that all repairs, including capital improvements, are made by the tenant. You cannot make a contract to violate the law. The court will set aside the contract and force you to pursue a judicial foreclosure. Use a normal mortgage, judicial foreclosure, or a non-judicial foreclosure trust deed, or all-inclusive trust deed, and a basic promissory note or a wraparound promissory note with conveyance of title, and conveyance of full responsibility, or a joint venture at the sale. If the borrower defaults, then foreclose to regain the property and sell it again. A non-judicial foreclosure for a trust deed is much faster than a judicial foreclosure for a mortgage. A straight note is a loan with all interest and fees rolled into the maturity amount. For example, a loan of $10,000 at 12% annual interest, compounded monthly, 0 monthly payments, due in 12 months calculates a maturity, balloon payment or total principal, of $11,268.25. Regardless of early redemption or any periodic payments, an installment note reducing the remaining unpaid principal balance, the total principal is owed on or before the maturity date. The benefit of no loan payments during the short-term renovation simplifies calculating the all-in investment. And early redemption increases the effective yield to the short-term lender. The SDIRA, or family bank, cannot spend monthly payments, so the compound interest improves the return on investment. Everyone benefits from a loan that is structured on a straight note. Joint venture. In a difficult mortgage market, a joint venture may be a good alternative to a mortgage loan. This financing is similar to Islamic banking. In Islamic banking, interest, called riba, is forbidden, and profit is strongly encouraged in a relationship similar to a partnership, where the bank provides the financing in exchange for a portion of ownership of the venture. The lender becomes a preferred equity holder, or finance partner, with no management authority. The investor is a common equity holder, which is similar to being the property owner, and has full or majority management authority. In the event of a failure, i.e., default, the common equity portion is transferred to the preferred equity holder according to the operating agreement of the limited liability company, LLC, that holds title to the property. The liability of the common equity holder to the preferred equity holder is limited to the membership interest in the LLC, non-recourse. Cross-collateralization is generally not allowed, because Islamic banking law frowns on multiple contingent contracts. Each contract, operating agreement, must stand on its own merit as a single transaction. The rental net income from the property is apportioned to the equity holders according to the operating agreement. The apportioned amount paid to the preferred equity holder is similar to interest but is considered profit under Islamic banking law. Part of the rental income that is apportioned to the common equity holder is paid to the preferred equity holder to buy out the preferred equity position, which is like principal amortization. The remaining net income is cash flow to the common equity holder. If the common equity holder is the occupant, then there is no remainder of the cash flow, because the common equity holder is paying the rental income. The lease agreement is between the preferred equity, lessor, and the common equity, lessee. This is similar to diminishing musharaka, which is the diminishing partnership or declining balance partnership. Take this into consideration when selling to Muslim owner-occupants. You can calculate a straight note at 0%, principal only, by setting the maturity term formula equal to the amortization term, setting the future value to 0, setting 10% annual interest rate, calculating the monthly payment, then changing the interest rate to 0%, principal only, then recalculating the present value, PV, or recalculating the amortization term. Or select the Select Straight Note checkbox and then press the Adjust Rate button or the Adjust Term button on the Seller Finance Flip spreadsheet. This will add a portfolio data row before calling GoalSeek. If the GoalSeek fails, then you can press the Portfolio Delete button to back out the garbage results. Important: be sure that there is no interest-bearing debt of any kind on the property. If you are using an equity loan, then be sure it is a straight note or installment note at 0% interest. Financial analysis: traditional rental. Here is an example of a traditional purchase of a rental SFR with a gross market rent of $875 per month. Gross scheduled income, GSI, $10,500 equals 12 times $875. Vacancy and credit loss, 8%, $840. Actual rental income, ARI, $9,660. Other income, $0. Effective gross income, EGI, $9,660. Gross operating expense, GOE, 20%, $1,932. Net operating income, NOI, $7,728. Capitalization rate, CAP, divided by 8.6831%. Capitalized property value, CPV, $89,000. Equity to value, ETV, 20%, $17,800, cash from you. Debt present value, DPV, 80%, $71,200. Annual interest rate, 6.0535%. Amortization periods, 360. Periodic debt service, 0.6030%, $429.33, cash from you. Annual debt service, ADS, 7.2359%, $5,152. Debt coverage ratio, DCR, 1.5, equals NOI divided by ADS. Annual debt constant, ADC, times 7.2359%, equals ADS divided by DPV. Loan to value ratio, LTV, times 80%, equals DPV divided by CPV. Capitalization rate, CAP, 8.6831%, equals DCR times ADC times LTV equals NOI divided by CPV. Cash on cash return, CCR, 14.4718%, $2,576, $214.67 per month. Leverage to yield, LTY, 1.6667, equals CCR divided by CAP. The traditional purchase of an income property requires 20% cash down payment and a high debt coverage ratio, DCR, to calculate a positive leverage ratio for the cash on cash return, CCR, divided by the capitalization rate, CAP. The CCR must be greater than the CAP for positive leverage to yield, LTY, ratio. If the LTY is equal or less than 1, then you should consider buying a lower priced asset with all cash to avoid the risk of debt default. If the property is distressed and requires repairs, then that is an additional out-of-pocket expense before the property can generate income. Adding repair costs to the down payment may turn an acceptable CCR into an unacceptable CCR because of a negative leverage to yield ratio. In the traditional rental business model, the landlord, you, invests a large chunk of cash in exchange for a small monthly positive cash flow. If you have no money for the down payment and repairs, then the model is not for you. Acquiring multiple streams of income is very difficult in the traditional rental model because the out-of-pocket costs quickly add up. You need a business model that pays you, instead of you paying it. Financial analysis, seller financing. When calculating the seller financing parameters to sell to an owner-occupant, the market rent is the basis of determining the seller finance valuation, SFV, which is different from the comparable sales valuation and the income, i.e., cap rate, valuation. The property is in an area that is primarily a rental community because of the kind of buyer that you want. Seller financing starts with the current market rent, and then subtracts the property taxes, property insurance, and the loan servicing fee. Some areas are controlled by a homeowners association, HOA, that requires periodic fees. You can account for the HOA fee with the miscellaneous fee. If the HOA fee or assessments are not paid, then the HOA can file a lien against the property that has priority over debt liens. You must collect these funds into a separate escrow account, and then pay those costs immediately when due. A bank or loan servicing company can handle these details, including tax reporting for the payer and payee. I recommend not investing in HOA communities because you give control of the property to the board members who only have their own best interests in mind. They can make your life miserable, even when you are a lien holder. Do not buy or lend on property in an HOA community. You can wholesale flip your contract without further liability. Annual interest rate, 10.7879%. Amortization periods, 360. Gross periodic rent $875, PITIMF. Escrow property tax $50, T. Escrow property insurance $30, I. Miscellaneous fees $10, HIM. Note servicing fee $35, F. Periodic debt service, PDS, 0.9363%, $750, P&I. Payment periods per year, times 12. Annual debt service, ADS, $9,000. Annual debt constant, ADC, divided by 11.2360% equals 12 times 0.9363%. Debt present value, DPV, $80,100. Loan to value ratio divided by 90%. Seller finance valuation, SFV, $89,000, 100% FMV. Down payment, 10%, $8,900, cash to you. Debt present value, DPV, $80,100. Note maturity, 180, $66,766.71. Principal reduction $13,333.29. Total interest payments $121,666.71. Total cash flow $135,000 equals 180 times $750. Note balloon payments $66,766.71. Note holder total cash $201,766.71. Family bank interest, 10%, $3,518, points. Miscellaneous entry costs $1,500. Closing costs, 1.12%, $1,000. Acquisition cost $15,760, purchase price. Renovation costs $13,400. Total equity investment $35,178, 39.53% FMV. Down payment $8,900, 10% SFV. Note effective investment $26,278, 29.53% FMV. Note effective annual yield, 34.57%. Start with the monthly gross rent, subtract the note servicing fee, escrow for taxes and insurance to calculate the available net income for servicing the debt, i.e., principal and interest. Multiply the periodic debt service, PDS, by the number of payment periods per year to calculate the annual debt service, ADS. Most areas in the United States use monthly rent payments. Other countries may use weekly rent payments that you can convert, multiply by 52 weeks to calculate the ADS, and then divide by 12 to calculate the monthly payment. The interest rate and amortization periods combine to calculate the annual debt constant, ADC. Calculate the periodic payment, PMT, for a debt present value of -1, a future value, FV, of 0, fully amortizing, for the specified interest rate and amortization periods. The PMT is the periodic debt constant, PDC. Then multiply the PDC by the number of payments per year to calculate the ADC. Divide the ADS by the ADC, or divide the PDS by the PDC, to calculate the debt present value, DPV, that can be serviced by the income. The note maturity, balloon payment, should provide long enough time for the borrower to establish sufficient credit worthiness to refinance the note with a low-interest long-term loan from a traditional lender, at least 7 years, probably closer to 12 years. Any increase in the fair market value, FMV, of the property protects the lender and helps the buyer to sell or refinance the property when the balloon payment is due. Your loan servicing company can report the payment history as a verification of mortgage, VOM, to your borrower's next lender to help qualify for the refinance loan. The calculated SFV should be within plus or minus 10% of the FMV. If the SFV is outside this range, then the property is probably not a good candidate for offering seller financing. Family bank. By the way, the family bank interest is a line item for your family bank. A family bank is a separate investment account funded by you, and possibly other family members. The account can be a simple savings account at a depository institution, such as a bank, or it can be far more sophisticated, like a high cash value dividend-paying whole life insurance policy bought from a mutual insurance company. Using a family bank lets you build intergenerational wealth by paying the interest to yourself with tremendous tax benefits. See Becoming Your Own Banker by Aaron Nelson Nash or The Bank on Yourself Revolution by Pamela Yellen. I recommend that the buyer invests at least 10% of the purchase price, seller finance valuation, plus closing costs to be sure that the buyer has an owner mentality, i.e., skin in the game, instead of a renter mentality. That means the DPV is 90% of the SFV. You structured the financing relative to what the buyer is comfortable paying for rent, so there won't be much argument about the interest rate. If the SFV is below the FMV, then you can remind the buyer of the discounted price by showing a list of comparable sales and the affordability of the monthly payments that match the market rents. That should end the debate and complete the deal. If not, then the buyer is insufficiently motivated to buy the property. Your price and terms are not open to negotiation because the benefits of seller financing are extremely attractive to buyers. I recommend that the annual interest rate is near to plus or minus 10% and it must be below the state usury regulations so that you can sell or borrow against the note to recover your equity investment and receive a positive net cash flow. Long-term lenders or note buyers are comfortable at 10% or greater yield, but this can vary due to market conditions, property type and location, and payer qualifications. Private equity financiers can realize higher yields than lenders or note buyers because their equity investment is much lower, which increases their leverage with created equity. Monetizing the seller finance note. Monetizing the seller finance note. To calculate your yield by holding the seller finance note, your all-in investment to buy and renovate the property, minus the down payment calculates your effective investment. Your note may have a face rate of about 10%, and your effective yield may be 18% or higher, depending on how low you bought the property. This is a great yield secured by solid real estate, especially considering the low yields of banks and the risk of the stock market. You are investing more of your money compared to a down payment, but the yield is much higher than a traditional rental model without the risk of ownership. In the traditional rental model example, the 20% FMV equity generates 14.4718% CCR. In the seller finance model, the 29.53% FMV effective equity generates 34.57% CCR. The higher yield is the result of the created equity wrapped by the higher interest rate. Increase your yield. You can increase your yield, CCR, to infinite by using other people's money, OPM. If you used private debt financing to acquire and renovate the property, then either that financing must be cost-effective to remain on the property and your seller finance note wraps that debt with an all-inclusive trust deed, or you can borrow from a long-term lender to redeem the short-term financing, or you can sell the seller finance note at a simultaneous closing, also called table funding, to redeem the short-term financing and put cash in your pocket. Either borrowing against the note or selling the note, i.e., monetizing, should be structured for cash out to you after redemption of the short-term financing, a portion of the periodic debt service over the life of the note, and a portion of the balloon payment. If you have a private equity financier partner who will leave his investment in the property and share the created equity with you, then that is a higher yield than the face rate on the note for a very safe investment. You're part of the note, part of the interest cash flow on the created equity and part of the balloon for the created equity, has infinite yield to you because you only invested sweat equity. You structure the deal so that your private financier recovers his entire equity investment. You share the interest income and the note balloon payment from the created equity. If you monetize the seller finance note to redeem the short-term financing, or to recover your own equity investment, then you are operating with unlimited leverage from other people's money, OPM. You are printing money out of thin air, and you are not a landlord. At the close of escrow, you receive net cash out, plus net monthly cash flow, plus a portion of the balloon payment. Your yield, CCR, is infinite because you have no net cash invested in the deal at the close of escrow to your buyer, and you have no risk of ownership. You are an investment banker by leveraging OPM. Sell the note at a simultaneous closing. Private long-term investors will buy a seller finance note conforming to their investment criteria. Most notes offered to note buyers are different from the investment criteria. Therefore, the terms of the note sale will modify the parameters of the cash flow to fit their criteria. A note buyer may require a discount from the face value of the note to increase the effective yield on the cash flow or to offset an early redemption. The periodic income stream or the balloon payment can be changed. In this example, the note buyer will invest up to 70% of the asset value, which is the lowest of SFV, FMV, CPV. The note buyer requires at least 10% annual minimum yield. The note buyer requires at least 5% discount from the note face value. The lowest bid of these calculations is selected, which is $62,300 that produces an actual yield of 10.49% for 180 payments of $595.97, plus a balloon of $40,060.03. Note buyer investment to value 70% $62,300. Note buyer minimum yield 10% $64,454. Note buyer minimum discount 5%, $4,005. Note buyer bid 10.49% $62,300. Note buyer maturity, $40,060.03, 180 months. Note buyer principal $22,239.97. Note buyer interest $85,034.63. Note buyer total payments $107,274.60 equals 180 times $595.97. Note buyer redemption $40,060.03. Note buyer total return $147,334.63. Your partial note sale provides. Note buyer bids $62,300, gross proceeds. Note sale redeem equity investment, $35,178. Note sale profit $27,122, net proceeds. Note sale down payment $8,900. Note sale upfront cash $36,022. Note sale net cash flow $27,725.40 equals 180 times $154.03. Note sale retained maturity $26,706.68, 180 months. Note sale total profit 257.13%, $90,454.08. You sell the property on a seller finance note and you simultaneously sell the note to a third-party note buyer. You receive net amount $36,022 at close of escrow as short-term capital gains. You received $154.03 per month for 180 months, totaling $27,725.40 as ordinary income. You retain $26,706.68 of the balloon payment as long-term capital gains. Your total profit is $90,454.08 after redeeming the initial equity investment. You earn 257.13% over your initial equity investment. If you borrowed the equity investment as a straight note, then the short-term loan is fully redeemed at closing and your yield is infinite. Most note buyers require the note seller to subordinate their position in the event of early redemption or default. This means that the note buyer has higher priority to receive early redemption payoff or the proceeds from a foreclosure auction, so that the note buyer receives the agreed yield, and the note seller receives whatever money remains, if any. The payoff is specified in a Schedule B amortization table attached to the note purchase contract. Some note buyers require seasoning the note to avoid the appearance of a lender. After closing, you must receive a certain minimum number of payments, usually one payment is sufficient, to prove that the payer will service the note as agreed. Other note buyers won't care about seasoning because of the protective equity and the note was properly arranged by a licensed residential mortgage loan originator, RMLO. Selling the note generates the lowest return for you, compared to the alternatives. Also, most of the cash is taxed at short-term capital gains or ordinary income tax rates. Borrow against the note at a simultaneous closing. This kind of note monetization is very much like selling the note. You are obtaining a loan secured by pledging the note as collateral, rather than the property, and then using a portion of the periodic cash flow to repay the loan. The long-term lender will lend a percentage of the note face value, at a lower interest rate with a shorter fully amortizing term. The loan should fully amortize before or on the balloon of the seller finance note, which means that the seller finance note balloon goes to you. Annual interest rate 8.0166%. Amortization periods 180. Loan to value 77.78%, $62,300, 70% FMV. Loan maturity $180, fully amortized. Loan principal reduction $62,300. Loan total interest $44,974.60. Loan total cash flow $107,274.60. Loan maturity $0. Note lender total profit $107,274.60. Gross proceeds from loan $62,300. Redeem initial equity investment $35,178. Net proceeds from loan $27,122. Down payment from buyer $8,900. Upfront cash $36,022, cash to you. Net cash flow $27,725.40 equals 180 times $154.03. Note residual net maturity $66,766.71, 180 months. Total profit 371.01%, $130,514.11. You borrow $62,300 at 77.78% SFV, 70% FMV. You receive $8,900 down payment from your buyer. You redeem the initial equity investment of $35,178, leaving $36,022 upfront cash for you. The loan proceeds are non-taxable. You receive a gross monthly income of $750 and pay $595.97 to your lender, leaving net monthly income of $154.03 for 180 payments, totaling $27,725.40 as ordinary income. You pay capital gains tax on the net principal reduction between the loan amount and your initial equity investment. An amortization schedule shows the interest and principal portion of each payment to your lender. After settling the loan maturity, you have $66,766.71 of the seller finance note balloon payment as long-term capital gains. Your total cash profit is $130,514.11, which is 371.01% return on the initial equity investment. You hypothecate, pledge, the seller finance note for the loan from the long-term lender. In the event of default, you can foreclose on the property to get the cash to repay your lender, or you can obtain a deed in lieu of foreclosure and resell the property, or the lender receives the note in full satisfaction of the loan without further recourse to you. Always insist on non-recourse for debt or equity financing. Never agree to a personal guarantee or co-signing for another entity. The pledged collateral is the sole recourse for default. You should include a note repurchase agreement so that you may repay the lender from another private financier, or you can have a substitution of collateral by reselling the property on a seller finance note and swapping the new note for the old note. Borrowing against the seller finance note generates more cash for you compared to a partial sale of the note. Hypothecating, pledging, the note as collateral is more complicated than selling the note. You need an experienced real estate attorney to provide the legal paperwork. Private equity financing. Teaming up with a private equity financier, or your family bank, is the easiest business model, and it generates the best returns. Your private equity financier provides the upfront cash to purchase and renovate the property, including carrying costs, taxes, insurance, and net cash out to you. You don't work for free, and your services are not on sale. You find and manage the project. The financier funds the project. Fair market value, FMV, $89,000. Created equity, 60%, $53,400. Miscellaneous costs, 1.69%, $1,500. Closing costs, 1.12%, $1,000. Renovation costs, 15.06%, $13,400. Maximum allowable offer, MAO, 22.13%, $19,700. Negotiated bid discount, $3,940, 20% MAO. Acquisition costs, 17.71%, $15,760, final bid price. Net cash out, 1.69%, $1,500, supervision fee. Closing costs, 1.12%, $1,000. Renovation costs, 15.06%, $13,400. Net capital raise, 35.57%, $31,660. Rolled-in points $3,518, 10%. Private equity total investment, 39.53%, $35,178. The ratios in the left-hand column are relative to the after-repaired fair market value, FMV, rather than the seller finance valuation, SFV, because in the event of default and foreclosure, the public will bid on the property relative to its FMV. Therefore, you want the actual cash investment to be much lower than the apparent debt, so that a lowball bid will redeem the cash invested and produce a net profit. If there are no bidders, then you receive title to the property, and then you can sell it again for another down payment to another qualified owner-occupant. Tip: I suggest structuring the financing as 2 debt tranches plus a wraparound note and all-inclusive trust deed, AITD. A junior interest-only tranche for the created equity, and a senior amortizing tranche for the private equity financier, and then wrap both tranches with a third lien AITD. The payer pays the loan servicing company on the wrap note and they split the payment between the 2 tranches. You pay tax on your ordinary income for the interest payments, and you defer capital gains tax on the created equity until it is received at maturity, balloon payment. The created equity, net maturity, of $44,922 is allocated to you and to your private equity financier, relative to your specified ratio. The rate and term are calculated for interest-only payments. In this example, there are 5 total units, with 2 units, ratio 40% equals 2 divided by 5, reserved for you and 3 units, ratio 60% equals 3 divided by 5, for your private equity financier. Periodic interest rate, 0.6678%. Periods per year, times 12, monthly. Annual interest rate, 8.0139%. Amortization periods, 9,999, interest only. Reserved units, 40%, 2. Financier units, 60%, 3. Total units, 5. Financier periodic debt service, $450 equals $750 minus $300. Financier periods per year, times 12, monthly. Financier annual debt service $5,400. Financier annual debt constant, divided by 12.0208%. Financier debt future value, $44,922, note equity. The private equity financier's base investment has an adjusted interest rate and term to shift all of the amortization from the created equity to the base principal. Annual interest rate 10.1539%. Amortization periods 277.7528. Periodic debt service 0.9363%, $329.38. Annual debt service 11.2360%, $3,952.56. Net capital raise 35.57%, $31,660. Available funds. Rolled in points $3,518, 10% DPV. Debt present value, DPV, 39.53%, $35,178, base principal. Intermediate interest, $0. Principal reduction $35,178. Monthly cash flow $450 equals $750 minus $300. Number of payments times 180. Total cash flow $81,000. Total principal, $35,178. Total interest $45,822. Principal $35,178. Net balloon $40,060.03. Total interest $45,822. Total return 17.4290%, $121,060.03. Your private equity financier invested $31,660 at 35.57% loan to value, LTV, which is very safe protective equity. You rolled in $3,518 deferred interest as 10% points. Then you sold the property on a seller finance note that generated for your private equity financier 180 monthly payments of $450 and a balloon of $40,060.03. Total cash to your private equity financier is $121,060.03, which is an annualized yield of 17.4290%. That is the kind of mailbox money that private financiers want. The steady long-term double-digit yield is fabulous for a SDIRA. In this example, the combined balloon payment to the private equity financier is near the amount of the initial investment. That is like an interest-only investment at a double-digit yield for years. Older, semi-retired, private financiers absolutely love interest-only investments because they want their principal to outlive them and then pass on the principal to their heirs on a stepped-up tax basis. If your private equity financier's situation changes and needs liquidity, the note can be monetized to recover the investment. You can buy out the financier's position with funds from a long-term lender, pledging the note as collateral for a loan, or you can offer a partial note sale to a note buyer, or you can substitute another private equity financier. Substituting another private equity financier is the easiest and best solution, especially when your exiting financier wanted a shorter-term interest-only commitment. Some older financiers will commit only for 5 years at a time, or they pass away, and the heirs want the investment fully redeemed. If the payer wants to redeem the note, then you can reinvest the funds in the next deal. Your private equity financier has many more options compared to investing in an irrevocable annuity, and the investment is backed by solid real estate, rather than the contingent liability of an insurer or by stock market variability. Your reserve total return looks like this. Reserve net cash out $1,500, paid to buy. Reserve down payment $8,900, paid to sell. Reserve total interest $54,000 equals 180 times $300. Reserve net balloon $26,706.68, capital gains. Reserve total profit $91,106.68. Reserved monthly cash flow $300, interest only. Reserve annual cash flow $3,600. Your yield is infinite because you have no cash invested, only your sweat equity. You received $1,500 cash out to supervise the project. You received $8,900 cash down payment when you sold the property on seller financing. You received passive income of 180 monthly payments of $300, interest only, totaling $54,000, with no ownership risk. After redeeming your private equity financier, you received $26,706.68 of the balloon payment as long-term capital gains. That's how to monetize a nothing-down deal for your own mailbox money. Equity loan. An alternative for equity financing is a short-term loan from a private financier. You borrow the equity investment as a 5-year, 60 months, fully amortized loan at an annual interest rate of about 12% plus 10% points. The effective yield for the financier is around 16%. The loan is secured by a first position lien, trust deed. All of the seller financing debt service is dedicated to the short-term equity loan for 5 years. You will not have any residual cash flow until that loan is paid off. So, arrange for some cash out when you close the short-term equity loan. Press the Equity Loan button on the Seller Finance Flip spreadsheet to calculate the parameters of a short-term private equity finance loan. Save the comma-separated values data. Summarize the parameters with the mail merge template Seller Finance Flip Equity Obligation. Your all-in net capital raise must be about 40% of the fair market value, and your deferred interest, points, should be about 10%. You can use the Straight Note button to try to calculate a straight note for paying off the equity loan. It will change the equity loan debt present value and the interest rate to 0%, principal only, to roll in all of the interest to the principal. If you want monthly cash flow by reducing the monthly payment to the equity loan debt service, about 10% of the payment should be alright, then use the Set Cash button to set your desired monthly cash flow net from servicing the equity loan. It will attempt to change the equity loan interest rate, or the amortization periods for a straight note, for the equity loan to achieve the original total amount owed to the private financier. Each of these buttons attempt to use goal-seek, which can sometimes fail and produce garbage results. Each of these buttons will add one or more portfolio data rows, so that you can back out the calculations by pressing the portfolio delete button until you get back to the data row that you want. When leaving debt on the property for seller financing, you will need a wraparound promissory note and an all-inclusive trust deed, and you must disclose the existing debt to your end buyer. Your attorney must provide the legal documents for the wraparound promissory note and the all-inclusive trust deed, which is a junior lien that automatically promotes to first lien when the short-term equity loan is paid off. The private financier money script. The private financier money script has been around for decades because it works. The best way to find private financing is not to ask directly for money, but rather to brag about the latest profitable project. Then ask, I know this is not for you, but who do you know that may be interested in earning 16% return on their money, secured by a first position lien on a good piece of real estate, for a short term of about 60 to 72 months? You are not approaching them for money, just information. If they respond with interest, then they are approaching you. If they say that they have money available, then follow up with, how much money are we talking about? They must answer with a specific number and not some vague response like, as much as you need for a great deal. Then ask, when can you deliver the funds? They must respond within a few days or less than 1 week. You are looking for a private financier that can finance the entire project as a first position lien holder and deliver the money within 7 days. A fractionalized trust deed is possible for multiple lenders to pool their money, but it's best used for a blanket mortgage loan on multiple parcels with a partial release clause for each parcel. So, look for private financiers that can each fund an entire project, or look for private financiers that will accept structured positions, first and second and common equity positions. Be sure that there is no due on sale clause in your private financing, so you can sell the property with seller financing with a wraparound note. If you don't have a specific property under contract, then talk about the median price range of the properties in your investment area. I see many overlooked or distressed properties crossing my desk that would retail for about $89,000 after renovations. I would buy an overlooked or distressed property like that for about $32,000, including all repairs, renovations, and carrying costs, to sell for $89,000 for a 72-month investment for my private financier. The annual yield to my private financier would be about 16% and is secured by a first lien on a property that will be worth at least 300% more after renovations. The power of compound interest makes these kinds of projects ideal for self-directed individual retirement accounts. Use the appropriate median price for your area, and then calculate about 30% to 50% for the all-in investment. Mentioning the self-directed individual retirement account, SDIRA, prepares the private financier for a no-payments type of loan or equity participation investment. Even without an SDIRA, the power of compound interest is a strong incentive. If you are looking for private financiers, either lenders or equity participants, for a medium to long-term hold, then try a variation of the script. I buy overlooked or distressed income properties from motivated sellers. I team up with flexible private financiers who can move quickly for a good opportunity. Several good opportunities cross my desk each week, which I offer to my private financiers at a steady 16% annual yield for years, secured by solid cash-flowing real estate that is worth at least 300% more than the investment. Who do you know would consider an investment like that? Wealth creation. Wealth creation. The key to wealth creation is multiple streams of passive income. With these kinds of deals, you can have multiple private equity financiers offering their SDIRA funds, or funds that they were considering investing in an irrevocable annuity, or funds from their own family bank. At 10 streams of passive income, just append a zero to the dollar amounts to see how this business model generates wealth to your private equity financiers and to you. Or can you run the numbers for acquiring 1 deal per month or 4 deals per month? How many deals can you manage when you are paid to buy the property, paid to sell the property, paid to collect passive income on the created equity, without the risk of ownership, and paid a lump sum when the note matures? Note restrictions. Note restrictions. Notes can have restrictions that limit the choices for either the lender or borrower. The fewer restrictions on your note, the greater flexibility the payee and payer enjoy. Recourse versus non-recourse. Upon default, the note holder may initiate a foreclosure action to force a public auction, cash sale, of the collateral to recover the investment. If the auction fails to produce sufficient funds to satisfy the claim, then a full recourse clause allows the holder to sue the debtor to recover the deficiency. A non-recourse clause prevents the holder from pursuing the deficiency. The collateral is the sole recourse available to the note holder. Prepayment penalty. The note holder wants a specific minimum amount of interest income and places a prepayment penalty on the note. If the payer attempts to prepay principal ahead of the agreed amortization schedule, then the payer must pay a penalty fee to account for the required interest. Lockout. The note holder may refuse to accept any prepayment of principal during a specified term. The payer must adhere to the agreed amortization schedule and cannot prepay any principal for any reason, including full redemption. Alienation. The alienation clause is also called due on transfer or due on sale. If the collateral is sold, transferred, or conveyed to a third party, then the note holder may declare the full debt immediately due and payable, including prepayment penalties. The clause is usually an option, rather than a required action. Note holders use the due on sale clause to qualify and extract an assumption fee from the new owner. A novation clause transfers all liability from the previous borrower to the next borrower. Recourse versus non-recourse. A full recourse clause is common in residential notes held by institutional lenders. If you have any doubts about whether the payer will care for the property to maintain its resale value, then I suggest that the note is full recourse to incentivize the borrower to maintain the property. Alternatively, you can include a reasonable care and maintenance clause in the note that is less onerous than full recourse. A non-recourse clause is common in commercial notes due to the low loan-to-value and high equity-to-value for income properties. Your decision depends on your tolerance for risk compared to the flexibility of non-recourse for the payer. Prepayment penalty. Note buyers often frown upon a prepayment penalty because a note buyer may negotiate a discount from the note's face value. An early redemption increases the yield to the note buyer and reduces the principal remaining at risk in the note. You already have built-in strong created equity in the note, and an early redemption will increase your yield. Lockout. A lockout clause usually appears in long-term commercial notes from conduit lenders who invest in commercial real estate notes. They want steady, predictable cash flow for decades. Borrowers are usually quite averse to lockout clauses, especially for their owner-occupied residential property because the clause hinders their ability to sell or refinance the property. A lockout clause requires fully assumable, but be sure that the assumable clause has no restrictions on qualifying or terms modification. Alienation. The alienation clause hinders the payer's ability to transfer the property during a down market, lower resale value, or when the payer is under financial stress. The payer wants to sell the property and let someone else make the payments, but the lender demands full redemption or onerous qualifying of the new owner. If the lender is happy with the payment stream and the collateral, then what is the difference of who is making the payment? Note restrictions. Your note should be collateralized by solid real estate with strong protective equity, not by the payer's credit report. Therefore, offer a non-recourse loan with carve-outs for bad behavior of the payer, e.g., filing for bankruptcy or wasting the property. By the way, consider requiring the buyer to title the property in a bankruptcy remote single-asset legal entity, e.g., a limited liability company, that is the beneficiary of an Illinois-type land trust, ILT. That will help to remove the asset from the public view of creditors. If the borrower files for bankruptcy, then your attorney can petition the court for quickly releasing the property and allow your foreclosure action to proceed. If the borrower just wants to give back the property without filing for bankruptcy, then the ILT beneficial interest can be privately assigned to you without a deed in lieu of foreclosure. A prepayment penalty will only hinder the payer and not increase your yield. Your yield is much higher the sooner the full principal is redeemed. Avoid a long-term prepayment penalty, but you may consider a short duration, 1 year, prepayment penalty to offset the difference between the short-term and the long-term capital gains taxes on the created equity. Absolutely avoid a lockout period. If you are satisfied with the financial terms of the note and the value of the collateral, then you won't care about who is making the payments. Your note should be fully assumable, so that the distressed borrower can find someone else to make the payments, either by selling the property with the financing already in place or renting out the property. You can include a note restriction that requires your approval to rent out the property. Remember, you calculated the financing cost relative to the prevailing market rents, so it is already affordable to prospective tenants. Qualify the prospective renter the same as you would for a buyer because you want to avoid the renter mentality tenants. Be sure that your attorney approves of the lease agreement, and that the agreement has a reasonably strong deductible for repairs. Whether the note is assumable with novation, or you require the original borrower to remain liable is a moot point. If the borrower sells the property subject to your existing lien, then the borrower probably is unable to find a cash buyer and is probably in distress. If the note is non-recourse, then there is no point retaining liability against the distressed borrower. In summary, for residential property, I suggest that your seller finance note is non-recourse with carve-outs for bad behavior. Your protective equity is strong. No, or short duration, prepayment penalty. Reducing the principal remaining at risk is good, but consider the capital gains tax difference. A 1-year prepayment penalty to offset the tax difference may be prudent. No lockout period. Fully redeeming the note at any time increases your yield. Assumable with novation. You may want to include a provision for qualifying ability to repay, ATR, to satisfy Dodd-Frank regulations. The next owner assumes all liability for the debt, subject to the non-recourse provisions. Have a note restriction requiring your approval for renting out the property. Try to accommodate your financially distressed owner. Ideally, a renter should be on a month-to-month lease with a strong deductible for repairs. You can get rid of a bad tenant by simply not renewing the lease. Also, moving back into the property when the financial situation improves is easier for the owner. Certificate of Occupancy, CO. A certificate of occupancy, CO, is typically required in the following situations. New construction: when a building is newly constructed, a CO is required before it can be legally occupied or used. It confirms that the construction has met all building codes, zoning laws, and safety regulations. Change in property use: if the intended use of an existing building changes, e.g., from residential to commercial, a new CO is often required to ensure the building complies with current zoning and safety standards. Major renovations or alterations: if significant renovations, remodeling, or structural changes are made to a building, a CO may be required to ensure the work meets local building codes and safety requirements. Property transfers: some municipalities require a CO during the sale or transfer of a property to ensure that the building is compliant with all current laws and codes. New tenants: for rental properties, a CO might be required when a new tenant moves in, especially for commercial leases. The specific requirements for when a CO is needed vary by local jurisdiction, so it's important to check with local building authorities or zoning departments. The Seller Finance Flip Spreadsheet. The Seller Finance Flip Excel spreadsheet performs all of the calculations described above. The macro-enabled version of the spreadsheet generates a comma-separated values plaintext file that can be imported into Microsoft Word for mail merge templates. The spreadsheet has an income and expense section for calculating the after-repair value, ARV, according to its income and debt. There is a section for calculating the seller finance value, SFV, relative to the market rent specified in the income and expense section. This section includes the parameters for the seller finance note. The note lender section is for calculating the parameters for borrowing against the seller finance note. The section includes a positive net monthly cash flow to you after servicing the loan from the seller finance note payment. The section is intended for a loan that fully amortizes over the maturity periods of the seller finance note, so that you receive the full seller finance note balloon payment. If you specify an earlier maturity term, then the balloon payment must be paid from some other source because the seller finance maturity will not yet be due. There is a section for the note buyer parameters for the investment criteria. Specify the maximum investment to value ratio, the minimum required annual yield, and the minimum ratio for a discount from the note face value. You can specify the amount of the seller finance maturity for the note buyer. The monthly net cash flow to you is specified in the note lender section. The private equity financier section has the parameters for sharing the interest cash flow and the seller finance note balloon payment. The spreadsheet has a button for calculating the reserved, your units and the financier units so that the total return to the financier is like an interest-only investment. This increases the yield to the financier above the face rate of the seller finance note.